All right, everyone. Right at the 12 o'clock hour, so we're going to get started. We have a packed agenda today. Want to welcome everyone to Cost Accounting for Medical Practices. I know we have a lot of changes and a lot of good information to help us kind of look at some approaches here with our webcast with Frank Cohen today. My name is Nicole McComber, and I'll be the moderator for today's session. The first part of the session will be about 50 minutes of presentation, and we'll have 10 minutes at the end for some Q&A. If you have questions that come to mind throughout the session, please write them down. If you're in our live locations in Hillsborough, Bend, or here in Eugene, and pass them to your host, and we'll make sure we address those questions at the end of our session. First, I would like to thank our sponsors today. We have MedFocus, and then Watkinson, Laird, Rubenstein, Baldwin, and Burgess, PC. Let me tell you a little bit about each of them. MedFocus provides medical billing to improve the revenue cycle, increase cash flow, and reduce time and AR for medical practices. Over the past 15 years, MedFocus has grown through referrals to be the largest Oregon-owned medical billing company in the state, and is proud to be every best practice measure. They provide a full suite of services from coding to collections, including pre-submission claim auditing, denial management, benchmarking, patient services, and client education. Thank you, MedFocus. The attorneys at Watkinson, Laird, Rubenstein, Baldwin, and Burgess, PC have diverse backgrounds as well. They have education, expertise, and life experiences in many areas of practice. From 4 offices across Oregon, the firm provides a broad range of legal services, including health law, business organizations, transactions, real estate, family estate, retirement planning, employment law, and litigation. The firm has developed areas of specific expertise to match the needs of their clients requiring specific areas of knowledge. The firm seeks to provide practice legal solutions through prompt, efficient, and cost-effective delivery of legal services. They value personal and professional relationships with their clients and aspire to exceed expectations in everything they do. Thank you, Watkinson, Laird, Rubenstein, Baldwin, and Burgess, PC. Now I'd like to introduce our speaker for today. Our presenter is Frank Cohen. He's a Director of Analytics and Business Intelligence from Doctors Management, a healthcare consulting firm. His areas of expertise include data mining, applied statistics, predictive analytics, and process improvement. Mr. Cohen is the author of several books, including his bestseller, Lean Six Sigma for Medical Practice. His experience includes 8 years as a physician assistant in both Navy and as civilian, clinic administrator, and hospital CEO. His clients include hospitals, large and small medical practices, medical and professional associations, legal and accounting professionals, government agencies, and other healthcare professionals. So let's begin. Welcome, Frank.
Well, thank you very much. Can you hear me okay?
Yes, we can. Thank you.
All right. Well, thank you very much, and thank you everybody for your time and your patience today. What we're going to talk about here is the idea of using RVRVS to do cost accounting. Now, I am not a CPA, but I've done a lot of work with it. Matter of fact, I'll brag, my daughter and son-in-law are both CPAs, so I can say that I have some experience working with them in some of this. My son-in-law is actually a CFO for a hospital, and my experience has been in the past, particularly working with smaller groups, where they get these very sophisticated cost accounting analyses done, and they have a hard time sometimes understanding and applying it. And any analysis, any work product for a provider or any client really, where they're not able to implement it right away or effectively, diminishes some of the value of it. So some people actually refer to what we're doing here as lean accounting. And the reason that they call it that is because what we're going to talk about here is the cost of doing business per se, as it directly relates to the product and or service that's being delivered. In this case, it's the procedures and services that are being provided to the patient. And this has been a holy grail for the years and years that I've worked in this area. And that is not understanding really what the real or approximate cost is for a given procedure or service. So what happens is, the payer comes along and they offer us a contract and they say, we'll pay you X amount of dollars for these procedures, and we're like, hey, we'll take it. And then we spend a lot of money having lawyers review the wording of the contract, but what we don't ever really know is whether or not what they're offering to pay us for that procedure results in a profit or a loss. And if it's a loss, then a lot of times it's better just to send those contracts down to our peers, to our competitors, if you will, within the community. So we're going to talk about this idea. We're going to do a little bit of a remedial study on RVRVS so that we're all sort of on the same page. Now the slides that you'll be provided will have a few more slides in it than I'm actually going to show you today, because within the hour I want to make sure we hit the high points. So again, this is the actual, our goal is to identify the actual or the estimated, not necessarily real time, but near time cost of delivering services and procedures within a medical practice. It's sort of a key part to it. And there are two major approaches to this. One is time motion studies. And I've been involved in many of those. And time motion studies are really good, I guess, for that exact highly specified area for which you are focusing. But the problem is that they tend to be non-standard. So if I'm going to use a time motion study in order to assess value or cost for what I do, and then go to a payer and let's say want to negotiate with that payer based on those costs, the problem that I run into is that it's a bit of a non-standard method, and they may not necessarily care. That's been my experience in the past. They're going to say, well, that's great, but we use RVRVS or some other method. The other part is I'm sure some of us have heard, is subject to what's called the Hawthorne effect, and that is when people know that they're being studied, then they tend to change their behavior. It's interesting, if you think about how productive you are the last day or two before you go on vacation, it's like amazing. That last 24 to 48 hours before vacation, we get more stuff done more efficiently than ever. And if we were to do that every day, we probably only have to work about 6 or 7 months a year to get the same amount of work done. What the Hawthorne effect basically says is if I come into your practice and I say, okay guys, here's what we're doing. I'm going to be studying all of you for your level of work effort and efficiency. Everybody's going to work harder than they might normally work because they know in fact that they're being tested. The RVRVS is far less sophisticated, but it is more accurate when used within the practice than we do when we do external benchmarking. So I know you can look at the UHC data or MGMA data or whatever. There's benchmarking data out there. But my personal experience is that RVRVS really has less value when I'm crossing over those boundaries than I am looking within the actual practice itself, because it's a relational database. And because it's relational, you poke the balloon at one side, you get a bulge at the other side. And while we may not have the most exact measurements at the most granular level, relationally speaking, the overall effect of that is that we usually have a pretty accurate assessment of what those costs are or going to be for the practice. It's also very inexpensive. As a matter of fact, it's free. That's about as inexpensive as you can get. The data are totally transparent. Everybody reads the same data file. You can download the physician fee schedule and RVRVS database from the CMS website, and there's no question about what it is and what it looks like, and that it's right there. It's readily available to us, and it's an industry standard. Now, there's a lot of complaints about RVRVS. As a matter of fact, I actually just saw an article today in the Journal of Vascular Surgery, I think it is, and in there it talks about the use, misuse, and abuse of RVUs, for vascular surgeons. And pretty much every specialty's got their own complaints about RVRVS. And you know what? It's not perfect, but here's the deal. It's here to stay, and it's what everybody's using, so we kind of have to just get used to it. So let's talk a little bit about RVRVS, and let's get a bit of a perspective of what the RVRVS is. So this is RVRVS 101. I'm not going to take a whole lot of time, to get into the real granular details. But I do want you to at least understand what the basic concepts is. So RVRVS stands for Resource-Based Relative Value Scale. And what that means is that there is a central value, and the value actually is supposed to be 1. And it actually falls on the 99213, which is the mid-level established office visit, E&M code. And then what happens is all of the other procedures and services that are provided to providers are relative to that particular procedure, okay? So in essence what we're saying is that if I have a procedure with a relative value of 4, then it's safe to say that the work effort involved in that is about 4 times, the work effort and the cost is about 4 times as much as that single value or that unit that's equal to 1. So the relative value unit itself is the standard unit of measurement. So if we were doing, if you were taking your car in to get fixed, for example, it's out of warranty and you take it to a shop and in this, you go in the shop and they look at it and they say, oh, you know, we did a diagnostic, here's what we think the problem is, here's what it's going to cost to fix it, okay? In order to assess what it's going to cost to fix it, they look in a book. It's called the flat rate book or the Chilton's manual, mostly is what that is. And in that manual there's a value, and the value is the number of hours it would take a certified technician in order to perform that particular repair, okay? So they look at the book and they say, well, this is what it is, you know, and that's that sort of unit. So we know that if it was a unit of 1, it's about an hour. If it's a unit of 2, well, it's 2 hours, so it's twice as much time as it would take for the first one. And then what they do is they add a geographic adjustment factor. And the geographic adjustment factor, the purpose of it is to identify the difference in the different values of the RVU based on where you are. So for example, is it more expensive to run a medical practice in Manhattan than it is, say, in Deer Lake, North Dakota? And not only is it more expensive, but how much more expensive is it? And these are also, this is also a relational database per se, in the sense that the national average adjustment factor is 1, and everything is adjusted plus or minus. So a geographic adjustment factor, say 1.5, would mean it's 50% more expensive or more valuable there than it would be somewhere else. And then finally, there's the conversion factor. In our talk of the Chilton's manual or the flat rate book for your car, the way you convert those hours into dollars is by multiplying the hours by an hourly fee. And the conversion factor, here's the thing to remember, the relative value units have no financial value at all. It's just a number that measures the consumption of resources. That's it. When you add a conversion factor, what you're saying is that here's the value, here's what we're willing to pay you, for example, for each of those individual units. And now what we've done is we've converted that into a financial model, into a financial value. Now there are 3 RVU components. There's the work-related, which measures the time and effort required by the provider to deliver these services. And the work is broken down into 3 parts. There's the pre, the intra, and the post. So, for example, the pre-service part of it in a surgical procedure might be meeting with the patient prior to surgery, doing an initial or final assessment, scrubbing, gowning, waiting for an OR. That measures what the pre-time is. For an E&M code, it's usually reviewing the chart or any lab work or ancillary studies that have been done to familiarize yourself with the condition or the patient's characteristics before you see the patient. Then there's what's called the intra-service. In a surgical procedure, for example, that would be the skin-to-skin time. So I just recently had back surgery, and that's when the physician walks in and lays hands on me to when they leave the room and the procedure's done. That's considered the intra-service time. Most of the time we refer to it as open to close time. In the E&M code, that is the time that the physician actually spends face-to-face with the patient. And in the post-service time, there's 2 parts to that. There's the immediate post-service, where the physician, in my case, came into the recovery room to make sure I was still breathing and I could feel my toes. And then the longer-term post-op, which is driven by, in Medicare in particular, and the private payers tend to follow it, is the post-operative follow-up time. So, for example, it may be that in my procedure, it's a 90-day post-op follow-up. So the average number of times that a patient getting a decompression procedure might come and see the physician, and they estimate what the number of time or minutes are. The work-related RVU is based solely on time, almost exclusively on time, I'm sorry. There's an effort part of it. But the time is managed by the American Medical Association by something called the RVRVS Update Committee, or the RUC Committee. And they're the ones who determine the average number of minutes that are associated to those procedures. Now, the practice expense related RVU measures the cost with performing the procedure. You know, how much material was needed, what was the, you know, the distribution of office space or lease space, or costs involved at the staff that are involved, the supplies, indirect and direct costs involved in that. And interestingly enough, we don't have time to get into it, but I do a good amount of work as an expert statistician in litigation support cases, particularly defending physicians against insurance companies that try to scam them when it comes to the contracts, and they're paying them based on RVUs. And you know, sometimes we see that, for example, the Budget Neutrality Act adjustment factor is associated here. So the practice expense related RVU also uses time, is my point, but it's far more confusing as to how that works. But in fact, it is based on that same time study. Hence, this is a truly relational database. The malpractice expense related RVU has nothing to do with malpractice. It's just, you know, it's never kept up with it. It's nonsensical, but it's there. For the most part, the work-related RVU across the board makes up about 53% of the total RVU value. Let me get my red pen out here. The practice expense RVU makes up somewhere around 44% on average, and so what's left is about 3% on the malpractice expense RVU. So the truth is, the malpractice expense RVU has a very minimal impact on what we do. The thing to remember is that when we get into evaluation management codes like office visit codes and that, we're really looking at closer to 73% on average for the work-related RVU. The thing I would say about the work-related RVU is that a lot of practices use it for physician compensation, and they're under this impression that it measures productivity, and it doesn't. It measures work effort, not productivity. The geographic adjustment factors then also break down by individual region. So just so you understand how this works when you're doing this cost accounting model. For example, the work-related GPSI says, how much is a physician worth, or let's put it this way, how much is a person with the equivalent education and training and skills of a physician? It could be a PhD scientist, it could be you know, a lawyer, it could, whatever, you know, in that range of education. What's their financial value, not their work value, but you know, what does somebody get paid on average in Deer Lick, North Dakota, as opposed to Manhattan, or you know, in Pittsburgh, Pennsylvania, compared to Clearwater, Florida, or something like that? The practice expense one looks at real expenses. It looks at what's the lease per square foot, rent, salaries based on SIC codes. What are nurses getting paid in Philadelphia compared to, you know, I don't know, Clearwater again, or Gainesville, Florida, or something like that. And the malpractice is adjusted by region also, and it does actually measure some of the differentials in malpractice, but again, it's a minimal impact on the total. So when you're calculating the total RVU, you know, what you do is, if you don't want the geographically adjusted, you just add the three components together, and that's your total unadjusted. I actually tend to work that way more often, because particularly if I'm measuring across boundaries, what happens if I'm measuring, for example, a physician RVU data for a practice in Manhattan, and I'm measuring it in Spring Hill, Florida, there's different of these geographic adjustment factors. And what happens is these elements here create noise in the equation. And so if there is a change, if there's a difference between something, I've got to be able to control for the noise, because what I'm searching for obviously is the signal in this. I want to see the effect, not the variance that's creating that. So I tend to go, I tend to go without using this, but if you're going to geographically adjust it, each of the components are adjusted first. So you take the RVU work times the GPSI work, the RVU practice expense times the GPSI practice expense, the RVU malpractice times the GPSI malpractice. You get the sum of these products, and you come up with a total. So in this case, the total geographically adjusted RVU is 3.555. If you want to convert that to the Medicare fee amount, you just multiply it times the current Medicare fee or conversion factor. And what we're saying now is that this procedure in this location is worth, well, the allowed amount is $127.35 under Medicare. All right, so hopefully that makes sense. If you have questions on this, feel free to write your questions into the chat box, and I want to make sure that I cover all of this. The key part to remember here is that that if you don't want to geographically adjust these, then just don't multiply it by the factor. It's a lot easier math, obviously. You're taking the sum of three components rather than the sum of the products of these components. And you can see where it makes a difference here. So in this case, it reduces the work RVU from 1.51 to 1.48. This one increases the 10%. No, it actually reduces significantly to 0.127 what the malpractice expense is. So again, you can look at this as that the number one is the relational value. So in this case, the work RVU is 1. So this is equal to the national average. Here it's 0.946. That just says that the expense component in that particular geographic area is about 94.6% of what it is as a national average. So I don't want to belabor this, but I want to make sure everybody understands this part of it. One of the key things to remember is that, again, and I'm just going to reiterate probably a couple times, RVUs do not measure productivity. They measure consumption of resources, and they have no financial value until you apply a conversion factor or some dollar amount that is used to convert those to a financial value. All right, so the first thing we do is we build the spreadsheet. This is where we start. So in the first few columns, we want to put the procedure code, what your charge is. This is really important. Some people say, well, why don't you use revenue? Well, the problem is revenue is so highly variable. For this 10040, you might get paid $100 sometimes, $60 sometimes, $3 sometimes, $80 sometimes. Our variable of interest is not the collection in this part. If you want to use collection, you can use an average collection in here, but I'm not comfortable with it. And if you're going to do it, you're going to have to create a confidence interval. You're going to have to actually calculate variance and error around this. Well, you don't have to. That's my recommendation. Because if you don't do that, you're going to be assuming a point estimate that's based on inferential statistics, and you really never want to infer a value across a data set without being able to identify what the error is. In this case, if you use your charge, it's a given. You charge the same thing every time. That's easy to figure out. You put the frequency with which that procedure was performed during this particular data period. I don't recommend doing a cost analysis any more often than once every 6 months, because you're financial folks, so you know better than I do that things come up annually or semi-annually. If you have lease payments to make, or if you have more than one 5-week month, or if you have a one-time payment for something, and it comes during one period rather than another, it can very much create noise in the model. And what we want to do is be as sort of accurate and have as little variability as we can in this. Then you put in the RVU, total RVU. You can use geographically adjusted if you want. Again, I told you I don't do it, because if I'm ever going to compare this for any benchmarking purpose at all, I can't compare it outside of my geographic region using that. You put the total charge. The total charge is simply the fee times the frequency. Okay? Fee times frequency, total charge. Total RVU, simple. That's the frequency times the RVU. So here we have 108.7325 total RVUs. The Medicare fee schedule amount, you can either look it up or you can calculate it. A lot of times it's easier to look it up, $64.53. And the conversion factor is $57.31. Now, here's the interesting part. For Medicare, the conversion factor, at least right now for this year, is $35.83, 35.8228. That means that for every RVU, for a given procedure, for every RVU, Medicare allows a payment of $35.8228. So, 83 cents. That, however, is not the only conversion factor out there. For this practice, their fee is $102. If you divide it by that RVU, okay, then that practices, they've priced that procedure at 57.31. Now, what does that mean? Well, let's take a look at that. 57.31 divided by the Medicare conversion factor of 35.8228. And in essence, what they're doing is, for this particular procedure code, they're billing about 1.6 times Medicare. Remember, this is the charge. You can go down here and calculate the conversion factor for every one of these procedures. As a matter of fact, it's pretty cool because if you look at this procedure here, the first thing you're going to notice when you do this exercise is that procedure is less than the Medicare fee schedule amount. Remember, Medicare's conversion factor is 35.8228. They're billing this out at $24.28. So they're losing a third of the Medicare conversion factor, or a quarter of it, or in that range, every time they bill out for this procedure. So even though this isn't cost accounting per se, there are some advantages to conducting a study like this. And then what we do is we total the fees and we total the RVUs. So we take a grand total. Here's my total charges. So what we're saying is that please bear with me in our imaginations and let's pretend that this is everything the practice did, all the procedures they did during this period of year. And that they billed out a total for everything they did of $223,384. And that consisted of 4,455.81 RVUs. Okay? Whoops, sorry. All right, so just take a look at this for a minute. That's actually just an excuse so I can take a sip of tea. All right. Now, do we include or exclude all of the procedure codes in the practice? And the answer is no, we don't. There are a number of procedure codes, many of them, that do not have RVU values. Thousands of them, actually, that don't have RVU values. What doesn't have an RVU value? Well, J codes, right? Those are drug codes. They don't have RVU values. Why wouldn't a J code have RVU values? Well, because there's no work effort. There's no, it costs a certain amount. You know what it costs. You know what you get paid for it. You don't need to calculate or estimate what that's going to be. You know, if you're buying your drugs at AWP, average wholesale price, or 95% of AWP, you know what it costs you for the drug. When you bill for it, you know what you get paid and what you don't get paid. So you know what your collections are. Heck, you can do a P&L on this stuff pretty as easy as a grocery store does on cans of beans, you know. So J codes are excluded. Why? Because they don't have RVU values. Look, one of the things I want you to notice about this table is that if it doesn't have an RVU value, it should not be included in this table. Okay? So in essence, it's not that the practice billed out $223,000 or $223,384. It billed out $223,384 only for those procedures that had an RVU value associated to it. This is really important, and you'll see why in just a few minutes. The rule is that we want about 80% of charges in the table associated to codes with RVU values. If you don't have that, then this is simply not going to work. So if you include a bunch of J codes, or you include a bunch of lab codes or pathology codes that don't have RVU values, or ambulance codes, or supply codes, you know, E codes or 99070s or whatever it is, and you include those, and you say, here's my total charge with RVUs, $500,000, that's 50%, and it's not going to work. You know, our experience is you've got to have a weight value of at least 80%. Okay, so basically that's how we're doing it. Now, if you want to break this down into a couple components, you can. We're going to do this based on total RVUs, holistic approach. Okay, you'll see how I do this, total RVUs. Okay, however, when we're done with that, you can do some investigational work. So maybe my cost per RVU is really high, okay, higher than what Medicare pays. So I'm losing money under Medicare. And what I want to know is, I want to know where's that coming from? Is it that my overhead is too high, or the physician's taking too much money out of the pot, you know, or more than what the practice can afford and still maintain profitability? So I could take, for example, just my fixed overhead and variable expenses. I could factor in by the practice expense RVU. Or I can just take the physician's compensation under this eat what you treat model, right? And I could divide it by the physician work RVUs. It'll work the same way, and you'll see as we go through this. So in this case, what we see is in this practice, they have 6,965 procedures they did. Now look, only 69 or 70% of all the procedures by frequency had an RVU value. But we don't care about that. What we want to know is that of the $942,475 in charges, 87.83% were associated to a procedure code that had an RVU. Okay, raise your hands if you think that this is okay then. Good decision. It's greater than 80%. That's the rule that we're working on. And in fact, one of the things we like to do is to look at where it comes from. So for example, only 1/4% are coming from J codes, 5.5% are coming from the laboratory charges, 1.16% are from the HCPCS codes, excluding those J codes. And then we have other codes. These are tracking codes and other codes, HCPCS level 3 codes and whatnot. But the key part is this: 87.83% are associated procedures of charges that have RVU values. So when you carve out the codes, let's say we have this situation. We have J codes that represent 32% of total charges. Okay, 79% of frequency by codes, but only 67% of charges then by codes with RVU. So what do? We take the J codes out. You take them from the gross charges. Now you should be able to do that easily, because if they're not included on the table, they won't be calculated. Eliminate their expenses. That's a known. You know what it costs for these particular drugs, and eliminate the revenue from the calculation, because you know what your revenue was for these, your revenues were for these. Then you run this cost accounting analysis just as if you had no J codes. And then you conduct the drug analysis separately. It's real simple. You know what the revenue is. You take the revenue, you minus the expenses, you get a profit loss statement. It's real simple, okay? You take that profit loss statement when we're done, you add it back into the RBRVS cost analysis, and you can get a full distributed data set from that, analysis from that. Hopefully that's not too confusing. I hope that this makes sense. All right, now, expense categories. You're going to have to decide which expense categories are included where. But here's the deal. If you look at the practice expense RVU as it's published by CMS, they tell you that these are the 6 areas, or the 6 expense areas that are included in the practice expense RVU. Total non-physician payroll, including fringe benefits. So that's your everybody else's payroll. Could be PAs and MPs, whatnot. Administrative payroll, including fringes for non-clinical staff. Office and facility expense. If you have renting, if you have a lease, if you're doing a 39-year depreciation on commercial property, utilities, all that kind of stuff. Okay? Medical supplies, variable expenses, disposable supplies, drugs, x-rays, films, and whatnot. And then your medical equipment. So if you're leasing x-ray equipment, or you purchased an MRI and you're depreciating, or you're doing rental on it, and then all the other expenses such as legal and professional, accounting, consulting, education, all that kind of stuff. And then for the physician side of it, they are defined by their salaries, bonuses, leases. Some physicians have their own staff. Leases here might be a car lease for them. Their educational budgets. Maybe I have docs who have their own PAs. Nobody else can use those PAs or NPs but that doc. Those are all defined into those direct expenses. The one thing you don't want to include is owner compensation, right? Because the problem with owner compensation is that, for example, if it's a sub-S corporation, then midnight December 31st, 100% of the expense part of it is at least 100%. So you're not going to get an honest look at what's going on. The way we apply these expense categories is we do the total expenses using the total RVUs. That's the big picture cost analysis. For again, less owner distribution at the end of the year. For investigational cost accounting, we would use the fixed and variable expenses, and we would only use that against the practice expense component. If you're including malpractice, not as a direct expense, you can also include the malpractice component. And then for physician compensation, we would use just the physician's comp, and then we would adjust that based on these work RVUs for compensation. So there's a lot of other things that you can do with this, very valuable tools, but you know, it all has to start with this cost accounting model. So let's get back to our worksheet we have here. So remember what we did here. We calculated the grand total charges, RVUs, right? Everybody got that? And then what we do is we divide the expense amount by the total gross charges, the expense amount. So whatever your expense it costs in there. So if it's 50%, you multiply 50% or divide it by half, whatever, to get your expenses for that a cost of doing business for the whole practice. So maybe you decide that your total expenses are 50%. You multiply that expense percent by the gross charges in the sample set. So you take total gross charges $1 million, expenses $500,000, your expense percent is 50%. You multiply it by the gross charges in the sample set. That's the cost of doing business, or that's what it costs you to generate that level of charges in that given table. So it looks something like this. In this case, the practice generates $3 million in charges. Okay. When we calculate all the expenses less the owner distribution, $1,181,897. You divide that into the 3 million, and we now know that for this practice, the cost of doing business is 39.4%. So here's what we're saying. I'm telling you that this practice has to spend $1.18 million to generate $3 million in revenue. I hope everybody's on board with that. So in essence, 39.4%. But in our table, because there were 496,500 procedures that did not have RVU values, we can't just use an expense of 1.182 million, because 1.182 million was spent to generate 3 million in revenue. I'm telling you that it's got to be less than that to generate $2.5 million in revenue. How much less? Well, I just take my percent here. As long as I'm close to this 80% in charges represented by RVUs, I'm confident that this percent of cost of doing business is applicable across the board. So in essence, I would multiply the 39.4% times the total charges in the table that only contain procedures that had RVU values, and now I get a total of 986,000. So here's what I'm saying again. I'm saying that this practice has to spend 1.182 million to generate 3 million in charges, and they have to spend 2.5 million, 986,000 to generate 2.5 million in charges. So I hope this makes sense to everybody what we're doing here. What we're trying to do is we're trying to filter the table only for those procedures that have RVUs, and then apply only the likely expenses, the estimated expenses, to that table for that amount. Now, if you're into statistics, what you could do is you could actually take this divided by this and create a confidence interval. You could say maybe it's actually somewhere between 36.4% and 42.4%. So you could create a range, because ranges are always more accurate than point estimates are. But again, that's up to you. I do it that way because that's how I do it, but you don't have to do it that way if you don't want to. Then what we do is we calculate the cost per RVU. Okay, so look, here's where we're at. $986,379. That's what it cost to generate $2.5 million in charges. I take the 986,379 and I divide it by the 32,445 total RVUs, So here what we have, listen, cost divided by RVU gives me cost per RVU. Now, I don't know about you, but the first time I did this, I fell off my chair in excitement. I couldn't speak. I got cotton mouth. I was trembling and having seizures. Okay, I'm exaggerating. But the fact is that this number is so stinking important. In fact, this is the holy grail, in my opinion, of financial accounting in the medical practice. What this is telling me, and I can now apply this across every other payer model, is that for every procedure I do, for every RVU that I consume, it costs me $30.40. Woohoo! I'm just excited. Okay? I got goosebumps. Now, what can you do with that? Well, for example, I can tell whether or not I'm making or losing money under Medicare, right? So right now, let's say the Medicare conversion factor is, I'm going to go back to my calculator here, is 35.8228, okay? And my cost per RVU is $30.40. So $30.40 divided by 35.8228. You know what that tells me? It tells me that my cost is 84% of the Medicare allowed amount. So the question is then, am I profitable under Medicare? Well, here's the problem. The problem is that Medicare only pays 80% of that. So 35.8228 times 80% is 28.6524. And so what happens is, if you take your 3040 divided by that 28.64, actually you're losing 6% on every single Medicare patient. Because if you're getting reimbursed at $28 and change per RVU, and it costs you $30.40 per RVU, you lose money under Medicare unless you're collecting the Medicare copay, the patient responsibility portion. This is just a little formula that you can calculate if you want to figure out what that collection amount has to be. Take the cost per RVU, $30.40, minus the conversion factor times 0.8, which is like, I think, around 28.6. You take that difference, you divide it by the conversion factor, 35.8228. I can't draw with this trackball. Then you take that times, actually it's supposed to be 5%, I'm sorry. And what you'll get is the minimum collection percentage. Okay, so in this case, this practice has to collect 1% of the copays in order for them to be profitable. Let's look at a real-life example. Here's a practice where the cost per total RVU is $32.09. It is 84.68% of the Medicare conversion factor. In order for them to break even under Medicare, they have to actually collect 23.38% of the 20% patient responsibility. So a lot of times we don't consider that. We look at Medicare and we say, oh, well, you know, Medicare is you know, 35.8228. As long as I'm there, I'm okay. That is absolutely not true, okay, because you're not going to get paid that amount from Medicare. And if you don't have a good system for collecting the patient responsibility either through secondaries or from the patient, then you stand the risk of losing money under Medicare. In fact, when that's the case, just multiply Medicare by 0.8, and that's going to be what your break-even area is. All right, so in contract profitability, we can use this across the board. Let's say that we have a contract that pays 120% of Medicare, okay? So 120% of that year's Medicare conversion factor, whatever it is. If the cost per RVU is less than the Medicare conversion factor times 120%, whatever the contract ratio is, then you should make money. For example, if the contract is 120% of Medicare, I have the 2009 up here, so I was just working on a contract where they're still using 2009, which is 36.0666. Then the cost per RVU has to be less than $43.28. Why? Because they're paying you this times 120%, which is $43 and approximately $43.28. So you've got to also consider holdback. What if they hold back 10% as a risk share, 20% as a risk share? You know, my experience is that insurance companies are inherently dishonest and unethical. And if they can keep that money from you, they will. If the law doesn't require it, even then, if they don't get caught, they're not going to give money back or pay money that they unreasonably owe to you. Okay? This is based on the entire contract. So you've got to look at all the procedures within the contract to determine how this impacts you. So then the next thing we want to know when it comes to looking at those line items is what is the cost per occurrence? Well, here's how easy it is. You take the cost per RVU, multiply it back by the number of RVUs for that procedure, and that gives you the cost for that procedure. So I know that every time I do a 10040, that my hard cost is $44.99. Medicare pays $55.26. Look at this one. Here's one where my cost is $83.91. I'm only billing $55. That's crazy. So I know I'm losing money every time I bill for this procedure. Cost per RVU times number of RVUs equals the cost for that given procedure. Now if you get a contract and the contract comes up and says, we're going to pay you, for example, they're going to say, we'll give you $40 every time you do this, you're going to be like, well, I'm losing $4.99. Can you make it up in volume? No, you can't. So the value of this is to compare this against your contract amounts to make sure that the fee schedules that are being offered to you are reasonable. You're not losing money on your. Now, when it comes to the idea of looking at collection for profit and loss, you know, collections, I look at collections as the actual dollar amount collected in relation to the billing period during a similar period, the billing. So what people try to do is they try to match, they try to reconcile the collections against the charges. But if you have an AR time of, 45, 50, 60 days, whatever, it's really hard to do because you got to keep going back. If you got AR lags out there. So you know what I do? I simply take the charges per month and I take the collections per month. That's it. And I divide them out, assuming that there's some degree of homogeneity month to month. And then what you can do is you can do it over, say, 12 months. You can take the average collection per month and create a confidence interval around that using variance and error. So you can actually say, oh, it's somewhere between this lower bound and this upper bound. So out of 100 periods, the actual collection value will be somewhere between this lower and upper bound, say 95% of the time. Calculating profit loss is just a formula. And all you're going to do here is you're going to take what your cost is for that procedure and what you collected on average. So average collections, average cost, average profit loss. Multiply it by the frequency, you get the total. Remember this code we talked about down here? Losing $24.85 every time you do it. This one, you lose $2.61 every time you perform that particular procedure. So you multiply the PL times the per occurrence times the frequency, you get a total profit loss. The truth is, when you're done and you do a summation at the bottom down here, that summation formula should be pretty close to what your bottom line PL is for your practice. The other thing I like to do is look at what you have here. You have the cost, right? And you have what you collect. Your cost, what you collect. Your cost, what you collect. I like to do a scatter graph, scatter plot of that. So I'm plotting my collection amounts against my cost amount. Notice what you have here. If you were to draw a regression line, you'd have a pretty nice, regression line here. But look what's happening over here. You can include these too if you want to. What I have is I have a group of procedure codes, some cluster, where the cost to collection ratio is significantly higher than it is for all my other procedure codes. And when that's the case, I go to the insurance company and I try to negotiate a carve-out with them. And we've actually been very successful at doing that. Calculating break-even fees, that is just a formula. And all you're going to do is you're going to take the cost per unit, or per code, divided by the actual average collection percent. Let's say if it's 80% you're collecting here, then you need to bill $67.73 in order to cover your cost of $54.18 at an 80% collection. If you're being reimbursed at 100% under managed care plans, which rarely happens, then the cost and the break-even fees are the same. In the practice expense RVU, it's the same thing we talked about. I'm not going to belabor this, but you're just going to use the fixed and variable expenses against the practice expense RVU, and it would just look something like this. So here, the cost per RVU, practice expense cost per, or the actual non-physician expense per practice expense RVU is $32.05. Not much higher, but a little bit than the actual. You can do the same thing with the cost per work RVU. You simply take the physician compensation less the distributions, the bonuses distributions, divided by the total work RVU. And in this case, we get cost per RVU of $48.45. Now, something interesting has happened here. The average cost per RVU was $30.40, yet the cost per practice expense RVU was 32 something, and the cost per physician expense is 48 something. That doesn't average out to $30.40. This is actually something called a Simpson's paradox. And unfortunately, we do not have time to get into the total explanation of it. But a Simpson's paradox is exactly what we've seen here, where you take two disparate measurements, and when you put them together and aggregate, it's not even close to, or it's not equal to what you would assess the aggregate number to be, and part of that has to do with the relationship between cost and frequency. So I would encourage you to Google Simpson's paradox, read it up and understand it. But basically what we're saying here is that it's the providers that are contributing to a higher cost. In essence, what they're doing is they're pulling from the pot more than the value of the services they're providing, not value humanly speaking, value financially speaking. Applications for the cost analysis, well, we could use the cost per RVU to calculate total RVUs reported by a provider, right? When you do this with collection per RVU, you can calculate productivity ratios. You take the physician's revenue as a percentage of the total divided by their RVUs as a percentage of the total, and the number should be at least 1. For academic institutions, we do this for looking at assessing and budgeting Part A costs, right? As to what the total cost per RVU is going to be, and then we reassess it back to the FTE ratios for those providers. In fee schedule analysis, we use this in order to determine whether or not we're charging enough to cover our own expenses. We can also use it to evaluate fee schedules that are tied to Medicare. When you're doing per member per month, we can use the cost per member per month to determine whether or not what we're getting reimbursed is appropriate or not. And in resource allocation is the other place where we use this. And in resource allocation, we're looking at the total cost, the total practice utilization, and we're calculating cost per 1,000 patients. So in the per member per month part of this, what we're trying to do, so if somebody's coming up and offering you a per member per month amount of, $2.85 or $15, you need to know whether what your costs are and whether your costs are able to manage that or not. And that concludes our presentation. This is how you can reach me if you want to. You can also go to the website at frankcohengroup.com, click on the Library tab, and the Workshop Toolbox link, and you'll find a toolbox in there under cost accounting. We'll have all kinds of examples, samples, and all that. And the password is 90153347. That's to unzip the file. That's not to get the file. You don't need a password to get it. But that unzips the file. And that concludes my presentation. Let's open this up for questions.
All right. I don't have any questions handed up this way. If you do have any, I'm happy to address them with the group. Frank, I'm not sure if you had any chatted to you during the presentation.
Let's see. No, actually, just can I get closer to the mic?
And Kevin, do you have anything you want to add today, or?
No, I don't think so.
Okay.
Nice job, Frank.
Yeah, thank you. We appreciate it. You know, if questions do come up, we are resourced. Frank provided his contact information where to get the materials. That we're happy to share these and follow up with you as things come up along the way. So thank you, Frank, and thank you to the audience today for having a great turnout.
Well, thank you. It's always an honor to be of service, and I'm available to answer any questions people have.
Thank you, Frank.